Live from Singapore, this is Insight with Haslinda Amin, a show where we dive deeper into the stories that matter with crucial context and sharp analysis. The dollar regains some ground in Asia after its two-day slide. Central bankers from Taiwan to Hong Kong are said to have intervened in the market. Many fear that Trump's aggressive trade rhetoric and flip-flops have undermined the dollar's haven status. Should tech investors be worried or rejoicing over the weaker dollar? We'll put that question to Goldman Sachs asset management tech specialist Sung Cho. He thinks the AI theme is still worth chipping into. Also ahead, the CEO of India's biggest hotel chain joins us exclusively to talk earnings and how the dollar drop may impact foreign expansion plans. It has been and continues to be about the FX space. Of course, the dollar index rebounding, weighing on Asian currencies at this point in time, reversing the losses we've seen in the last 2 days. Of course, we've seen that stunning spike in the Taiwan dollar reverberating across global FX markets. The market rattled by potential trade talks and currency re-evaluation. Take a look where we are in terms of those currencies. The Taiwan dollar front and center. Currently, it is down 0.5%. We're seeing losses too for the likes of the Chinese Yuan, currently down by 0.4%. Of course, the large and seemingly coordinated appreciation of Asian currencies boosting speculation perhaps of some sort of currency agreement among the region's central banks. Let's dive deeper into the latest FX moves with our MLive executive editor Mark Cudmore and Bloomberg Intelligence chief Asia FX and rate strategist Stephen Chiu. Mark, first question to you. What's going on?
I wish you didn't ask such open questions. There's a lot going on at the moment. I think this is the next kind of logical leg of the dollar depreciation story. I do think that some of the moves in recent days are being overinterpreted because of the low liquidity we've seen. So they're really being quite exaggerated. And I don't think, what we've seen in Taiwan dollar is truly extraordinary. We've never seen a move like this. And this is like a 7 sigma move. You're not meant to see this in kind of markets. So I do think there's going to be some give back. But I think the overall theme here is, while it's being overinterpreted in the short term, is a valid one. And that theme is that investors around the world have realized that they are overexposed to the US dollar. They're overexposed to US assets, and they haven't properly hedged also the FX risk around that. And ultimately, people are getting more concerned about the policy decisions made under this administration, and they want to reduce their US asset holdings. They want to reduce their US dollar exposure. This does not mean a panic. This does not mean that the end of the US as the world's reserve currency. It just means they want to cut that exposure down to being their largest holding rather than a really extreme holding.
Stephen Chiu, lots of speculation out there. Some people are saying that perhaps it's all part of negotiations to do with trade and currency in the midst of it all. There's also speculation when it comes to the Taiwan dollar. It's really about those insurance companies hedging against the dollar. What's going on there? Is it all the above, none of the above?
Yeah, of course, as Mark has alluded to, it could be due to the liquidity because China is out, right? So any news, there are news about US-China, we're talking that's actually just a little news, but markets sort of trigger on that, and we saw dollar Asia slumping, Taiwan dollar slumping. It's kind of sort of like an extension of the dollar slump, because if you look at the data, look at the FX market over the last few months, the dollar dropped, but it actually only favored the major currencies, especially euro and yen. Asian currencies, if you look at it, if you measure it in non-dollar terms, for example, euro, yen, it's actually quite weak because market were afraid this trade war actually will hit Asia the most. And now markets sort of reversed that because they thought trade deals are coming out, possibly with Korea first, Japan, Taiwan, not so much China. But now market just had a relief rally when China is out. So, I could understand that. Nobody could call the timing, but the move is understandable. But we have to know from here, it might be too extreme, as Mark has alluded to. Taiwan has spoken yesterday, and we saw Hong Kong intervening. And after all, we're talking about Asian exporters, so the currency can't be too strong, and the economy will be damaged as well.
But the rally in Asian currencies, Stephen, it was just a matter of timing. It was going to come anyways. It's just been accelerated, given expectations that the dollar is set to weaken for the rest of the year.
I mean, yes, as you said, it's going to come anyway because now market is really finally, we've been talking a lot about de-dollarization. I think now that theme is accelerating, firstly in G10, now in Asia. Now, for the rest of the year, I think market has already flipped their mindset. It's going to be a sell and rally. So any like peak, any rebound in dollar Asia are actually a good entry point. So I do think the downtrend in dollar Asia will continue, but the pace has to be moderate. Otherwise, central banks will have to step in because after all, as I said, most of them are exporters.
Overdone moves so far, you say. How do you think central banks in this part of the world are looking at their currency strength?
Well, what this is going to happen is create a kind of virtuous cycle in terms of reserve diversification. So what they're going is, as Stephen kind of mentioned, they can't afford too strong domestic currencies, and especially on a trade-weighted basis. So what they're going to start doing is try slowing these appreciation moves. Again, Stephen said these moves are logical, but they have to go at a certain pace. And what happens is, as they start accumulating dollars to kind of stop their currency appreciating so fast, that's doing the exact opposite of what they want, which is to decrease their exposure to the dollar, which means they're going to have to buy more of the other G10 currencies. So what this kind of dollar Asia move is flags that we're probably ready for the next move in G10. So these central bank nations will buy dollar Taiwan, dollar Korea, dollar Indian rupee, etc., and then they'll use those dollars to sell against the euro, against the yen, against sterling, and other currencies. So what we're doing is we're going to see a broadening out of the rally from here, not just dollar Asia focused.
It's complicated for central banks because the governments are negotiating with the US, with the Trump administration, and this will be seen in a way as currency manipulation.
But it's the currency manipulation that I think that the US government seems to want. So they're going to be going, hey, look, we're letting our currencies run. Sure, they're actually going to be intervening to slow the appreciation of their currencies.
A weaker currency.
But that won't be the point because the direction of travel is what matters. And we've seen many times that there's a selection of facts used in these negotiations by the US administration. And it's the headline moves that I think they'll care most. So I don't think that's going to bother them too much. They're going to say, if Taiwan, for example, said officially that FX has not been part of the trade negotiations, but they can say, look, well, our currency is appreciating lots where we're playing on your terms. So I think it'll help the negotiations, if anything.
Stephen, lots of murmurings out there questioning the status of the USD as reserve currency. Here we go again. If you say that the movements we've seen so far is pretty much overdone, then we're back to the fact that it remains a reserve currency.
Yeah, I mean, like, I'm not saying that it's going to accelerate and continue all the way to sort of like for the dollar to topple, but this is certainly a trend, a multi-year trend that's starting right now. So going forward, I think market would start to pick other reserve currencies, meaning that actually for traders, for investors, it may make sense even when they are trading Asian currencies, they may have to start to look in a multilateral perspective. For example, like Asian currency, whether we talk about strength or weakness, it could be in a basket context. It could be like a bilateral rate against the euro, for example, since Eurozone is actually a large trade partner for the Asian economies as well. So going forward, it's not just about US and the dollar, and the market will also look at other bilateral crosses.
Are we underestimating the scale of the dollar decline?
Yes. In terms of that, whenever you get a regime shift, people always underestimate it. I want to be very careful about saying that. We've seen quite a large moves over the last couple of months, and it doesn't have to continue at that pace. But how far can these things go? They always go much further than they think. I got kind of mocked when I said back in February and March that I said, as an arbitrator, I said I thought that euro-dollar would go to 130 before 104, and that was when we were trading at the 107, 108 level. And I think that's the point. Everyone's like, 130? You know, you're talking about 20% move, but that's the kind of scale of moves we're talking about here. I think it's going to be like a low beta version of the mid-2000s. And the narrative of the mid-2000s, sure, there was the rise of China, there was the rise of the EM, there was the credit bubble. But a lot of what it was is that we are moving into a multipolar world. So we're going to have the China, EU, and dollar prop up a world with strong EM countries as well. And people were going to diversify. So people were selling down the dollar, and then they're diversifying into other assets. We don't have the exact same narrative today, and it won't be quite as strong, but I think we've got a similar narrative that people are going to go, hey, we've just gone from 15 years of there's no alternative to the US. Everyone's just piling into the US with every kind of marginal dollar. And suddenly they're going, that was a terrible idea. We want to go back to a multipolar world. Sure, we don't have the obvious examples. We don't have the narrative of the 2000 that China and EU are viable contenders, but we do want to get out of the US, and I think people are going to diversify much more broadly. So yes, over the next couple of years, I think people are underestimating how far this dollar move can do, and the risk of like, sudden panic moves at certain times. It does not mean it needs to happen in the space of a couple of weeks, a couple of months. It's multi-year.
Do you see the euro playing a more prominent role? If you take a look at the movement so far, 5-6% gains in just 2 weeks.
Yes, I do in terms of reserve holdings, but that's a much longer term story. Remember, we're not going to see the impact of the German fiscal spending on growth for another year or so. And really, the euro can't keep on taking a much bigger share without a much bigger growth in its debt market, which we're going to see over the next couple of years. So I think euro is going to play a larger share in reserves over the coming years, but I don't think that story is behind. I think that story is kind of running on track of where it should be. I think it's the other alternatives that people are going to look at. And what will be most interesting is if, as part of the trade negotiations they might get, we expect the US administration to get some wins, well, they'll get some opening of some capital markets. Now imagine if you get much opening of some of the Asian capital markets, some of those currencies will prove viable contenders as a larger percentage of reserve holdings. It may not be much, you might suddenly increase to like 1% or 2%, but suddenly that will be material for some of these nations.
Stephen, do you agree when it comes to the scale of the dollar decline?
I'm completely with Mark in talking about the multilateral reserve currency world 100%. Actually, I want to bring in a point here. Actually, the currency that's going to benefit the most is actually gold. Because usually when we talk about global FX order shift, reserve currency shift, usually which currency benefit first is gold. Because at the end of the day, all the fiat currencies might be the same. It's only because of the credibility of the central bank. So if central banks, investors are going to dump the dollar, yes, euro, yen, or even yuan could benefit to some margin, but the largest beneficiary got to be the gold. That's why central banks have been buying gold for a few years already. That's why gold prices are at record high if measured in the dollars, and that's going to be the trend. I mean, if you look at the global central bank reserve holding data, usually people don't talk about gold, but if we throw in gold denominated in dollars, it's actually the second largest currency. It has overtaken euro last year already, and that's going to be the trend for the next few years.
And as you said, central banks have been buying gold, the PBOC in particular. And speaking of China, we have a line here saying that China's May holiday inbound and outbound trips actually surged by almost 29%. Stephen, when it comes to the yuan, where is it headed? And also in terms of its role in the future, how do you see that developing amid efforts to internationalize the currency?
Yes, I think what's interesting is when we talk about whether the yuan is strong or weak, we have to look at it at a basket context, CVAS. Because one of the most clear trends this year is actually the downtrend in the yuan basket. Because as we know, China do want to counter the impact of the tariff by weakening the currency. But if you look at dollar yuan, it's doing nothing. 7.4 back to 7.2, it's going nowhere. But if you look at the basket, it has been weakening. And we know that the PBOC gotta give green light to that for the yuan basket to weaken. So we can see that from a basket perspective, the yuan could stay weak for now. For dollar yuan, it's more about dollar story. It could just be more like a fixed exchange rate at about 7.1, 7.2. And finally, on globalization, I think for now it's still too early for the yuan to take over. We're still talking about the major currencies, euro, yen, and even gold. For yuan to globalize, I mean, like China really have to open up the capital market and to some extent to narrow the trade surplus. But that's very hard to do overnight for China.
Mark, I just want to throw it out there. Stephen talked about gold. Now some people are saying that actually Bitcoin looks like it could be that haven play, that haven, that asset that people might be looking for.
I do think that Bitcoin is going to benefit this environment, hasn't benefited in this environment, and will continue to benefit in this environment. I remain a long-term cynic of paying, almost $100,000 for a line in a spreadsheet to say that line in your spreadsheet's yours. And I know that's going to get me lots of hate mail. But I do think this is a good environment. And I don't think that just because I'm a long-term cynic of Bitcoin, I don't think you should be actively bearish. I think if ever you want to be pro-crypto, this is a relatively good macro backdrop in terms that fiat currency has been challenged. The world's only serious contender to be the world's reserve currency, the dollar, is being undermined. And it doesn't mean there's no one else to take its place, which means people are going to diversify. They're going to go into gold, they're going to go into crypto, they're going to look at other currencies. Now, at some point, I get worried. Now, the other dynamic here with Bitcoin is apart from while the macro environment is very good, it's already very, very expensive, again, for your line in a spreadsheet. And I think it is very much retail exposed. It is very exposed to sentiment. And I think the coming 6 months or even the next couple of coming months will be very tough for stock markets. And I think that might hit crypto very hard. So the macro backdrop, good. Short-term sentiment backdrop, very bad.
Interesting views. MLive Executive Editor Mark Cudmore and Bloomberg Intelligence Chief Asia FX and Rate Strategist Stephen Chiu. Thank you so much for being on the show. Now, still to come on Insight, hear why Goldman Sachs Asset Management thinks the U.S. tech sector remains well positioned to outperform despite the uncertainty around tariffs. Keep it here with us. This is Bloomberg. Welcome back to Insight. Trump's so-called Liberation Day tariffs and the resulting dollar weakness are also putting a spotlight on U.S. tech stocks. Investors are grappling with the possible short and long-term impacts of a weaker greenback across corporate balance sheets, impacting everything from overseas revenues to component costs. As this chart shows, the dollar's run or weakness corresponded with a slump in the Nasdaq before tech stocks bounced back thanks to resilient earnings. Joining us now, Sung Cho, co-head of public tech investing and portfolio manager at Goldman Sachs Asset Management. Sung, good to have you with us.
Great to be here.
So these gyrations in the markets, dollar weakness, dollar strength, I mean, how's it playing out in the tech sector?
Certainly, it's been a wild ride for the tech sector. We've seen a 23% decline not too long ago on fears of Chinese competition, the Trump policies that are taking, into effect. And then more recently, we see a 15% rally right back. And I think the world is asking, like, what's going on? And I think part of there's a tug of war going on between the policies that are being put in place and the anticipated potential impact of those policies and the actual fundamentals on the ground. And the fundamentals on the ground is that corporate earnings are still really, really good. In Q1, the S&P is on track to actually grow earnings 13% quarter on quarter or year on year, and the expectation going in was 6 or 7%. So, corporations are delivering strong earnings, and in particular, the Magnificent Seven is delivering strong earnings. Cloud growth accelerated. They did not decelerate. They actually accelerated. There was a lot of concern around weak advertising spending, potentially, even with Temu and Shein pulling back. And actually, advertising budgets held up fairly well. And so there's this tug of war between currently strong fundamentals, a perception that maybe these fundamentals could be weakening. And I think that's the tug of war that's creating gyrations in the market.
We talk about earnings, and earnings will dictate where valuations go from here. It is interesting because if you take a look at the currency, for instance, the Taiwan dollar, front and center, and we know what Taiwan means for the chip space, right? We have the likes of Apple, NVIDIA, all doing business with TSMC. How might that strength in the Taiwan dollar play into the space?
Look, the fortunate thing about semiconductors is outside of NVIDIA and that ecosystem, the semiconductors generally are fairly small price relative to the bill of materials, right? So to the extent that there's a little bit of inflation or deflation from a semiconductor perspective, it really shouldn't impact the health of the tech sector. And on top of it, one of the nice things about the tech sector is that the consumers of the semiconductor, whether it be the big cloud companies or Apple, have the ability to actually pass along this pricing. And because of their competitive position, they do have a lot of pricing flex. And so we think that there could be some short-term impacts, but that medium to longer term, there could be resolved in a lot of different ways.
Talk to me about the valuations you're seeing in the tech sector. People said earlier on that the valuations can be justified as long as earnings are in excess of 20%. How are we looking at that now?
No, it's always funny when people comment that earnings are being justified, right? That's when right before you get a little bit of a correction. But let's take a look at like where tech multiples now sit relative to the S&P 500. So, if you look at the long average, the last 15 or 20 years, after the tech bubble, we're looking at that period, tech has traded at about a 28% premium relative to the S&P 500 historically. Right before kind of DeepSeek and we had that big correction, it was trading at about a 35% premium, so a higher premium than historically. Right now, even with this rally, it touched off at kind of 5% premium. Now we're at a 15% premium. So even with this move higher, we are actually at a discount relative to historical premium levels. So it's hard to say that tech is expensive on any kind of historical measure, and we actually think it's relatively undervalued relative to kind of a medium to longer term trajectory.
But of course, expectations are that global growth will slow, spending might be impacted.
Yes.
We've yet to see hard data showing all of that.
Yeah.
So that's a big question mark to the valuations and earnings outlook.
That's absolutely right. People, when typically things trade at a discount to relative to history, it indicates that the market expects that earnings are going to actually deteriorate going forward, right? And we just fundamentally disagree that tech earnings are going to be less resilient than the rest of the market. And it's a couple of different things going on, right? One is, typically you want higher gross margins, right? Because higher gross margins means you have competitive differentiation to be able to flex pricing. It also means you have less cost of goods sold, which means you have less impact from tariffs. And tech generally has higher gross margins than the rest of the market. On top of it, you want clean balance sheets in this type of environment to be able to invest countercyclically, whether it's M&A or through corporate buybacks. You want to have the balance sheet flex to be able to do that. And we've seen some of the announcements from tech companies recently flexing their balance sheet to be able to do this in this kind of environment. And so from a lot of different indicators, like whereas gross margin health or balance sheet health, or actually durable end markets like AI, we think that tech is actually going to be proved to be more resilient. That's what's creating an opportunity on a relative basis. And who knows exactly where the market is headed. But from here, we think that tech gives you a little bit of a combination of both offense and defensive characteristics.
So if you take a look at the next 12, 24 months, love big tech again. We've gone from loving them, not loving them, and now we're back to thinking that we should be owning them again.
The one thing that's about tech, especially the Magnificent Seven, is that they have a unique way of picking up market share during periods of distress. Right, you're seeing Amazon right now also benefit from the, Temu and Shein, obviously because the tariffs have become a little bit less competitive. They're going to pick up market share from some of those competitors that were starting to emerge. Likewise, you had advertising budgets. Everybody going into earnings that Meta was at risk because advertising budgets and 10% was coming from Temu and Shein, and they actually were able to replace that advertising space with other advertisers as well. And so, the strength of these franchises are always persistent, but they get accelerated and highlighted even more during periods of distress. And I think we're seeing that play out right now.
What is the biggest risk to all the assumptions you're making right now?
Yeah, look, I think the biggest risk right now, I think, underlying the tech sector is this trajectory of AI spending. Can AI CapEx continue to sustain the semiconductor
And you say
sector?
so far so good.
And so far so good, right? And I think what we saw from the announcements more recently is that AI CapEx is not decelerating, it's actually accelerating through earnings, right? So companies like Meta went from 68 billion, I think it was, to now guiding to 74 billion. Google, Amazon, even Microsoft, there was a lot of noise around, are they cutting data center CapEx and things like that? And that ended up being wrong as they reiterated CapEx. So, I think the CapEx equation is something that's a little bit more misconstrued and misunderstood, but we think that the trajectory of CapEx is actually still fairly strong.
So buy the dip. Anytime you see a dip, you buy into that sell-off?
Look, I think, somebody always told me, look, the market tends to outperform 6 out of 7 years or whatever it is. And so the 1 year that it's down, why would you not buy that year, right? So I think that's, I think, obviously it's always good to, stay long the market. There's obviously reasons to be able to broaden out and diversify your investments. But I think tech is it's going to continue to be the source of global innovation.
It's been a pretty fickle market, Sung. Hang
Yeah.
tight. Sung Cho stays with us in a moment. We'll discuss Goldman's buy the dip call on the AI sector, more on the outlook for tech ecosystems next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Goldman Sachs analysts see a buy the dip opportunity in the tech names linked to AI, thanks to a recent run of improving earnings. This chart shows a Goldman basket of AI-linked stocks bouncing back in the past few weeks after a sustained run of losses earlier this year. Results from the likes of Microsoft, Meta, and Alphabet are helping restore confidence in the tech sector, which got hammered on concerns about cheaper Chinese competition and uncertainty over President Trump's tariff policies. Sung Cho of Goldman Sachs Asset Management is still with us. We talked about how DeepSeek changed the way people looked at AI. Are they changing the way people invest in the space?
I don't really
fundamentally.
I don't think it fundamentally changes much. And I think what DeepSeek did was it really exposed kind of how one-sided the trade had become. And I think the reaction that we saw post-DeepSeek from a stock perspective was really just an fundamental unwinding of the consensus long. And because people had gotten so one-sided, it exposed that. But from a fundamental perspective, whether the innovation is coming from DeepSeek or from US players or from other players, like it really doesn't, this is the natural cadence of innovation, right? And so it doesn't really fundamentally change our outlook.
The thing is, the Mag 7 is an overcrowded trade. It still remains an overcrowded trade.
Yes.
If you remove that Mag 7 theme, what are the next biggest themes in tech?
There's so many different ones that are going on. Now, let's talk a little bit about 2025 and where we see kind of the biggest opportunities outside of the Magnificent in 2025. The first one is kind of the data and security space within software. So what's interesting about AI is that AI so far has primarily focused on all the publicly available information that's out there, right? All the publicly information out there, and that's going to be mostly trained within the next 1 or 2 years. And so you start running out of data. But what is the actual gold mine for AI processing? It's really around what sits inside corporations, what sits inside Bloomberg, what sits inside Goldman Sachs. This is the data that needs to get trained. But the reason why these data hasn't been trained yet is because we're still very protective of our data infrastructure, and we want to make sure that there's security around it. And so we think that in 2025, software companies that help provide the data security around this, that also allow you to organize this data and such to be ingested into these large language models, are going to be the ones that benefit the most.
So having said that, where are the undervalued opportunities?
Yeah, so I think that's, ultimately, what's undervalued is relative to the growth, the multiples are fairly low. I think the software companies that I just mentioned are one example. The second is, as a result of the correction that we've seen more recently, we're really leaning back hard into the semiconductor space, and particularly the AI semiconductor space. And within the AI semiconductors, it's not the big leader in GPUs, it's actually the ASIC related semiconductors. And we think if we just recently kind of did an analysis of like where we think that market is headed over the next 5 years, and we think it's going to go from $10 billion in revenues to nearly $70 billion in revenues over the next 5 years. And it's going to be one of the fastest growing subsegments of the semiconductor market. And this, given the kind of the correction, we think it's very, very underappreciated in valuation.
Well, the thing is, for investors, it is about returns. You know, when you take a look at the other tech themes that you've just talked about, can we see the kind of returns that we saw for Mag 7?
Yeah, so I think if the thesis plays out that we're going from $10 billion addressable market for ASIC semiconductors to $70 billion, anytime you get a 7x tripling of TAM just in a short period of time, the multiple that you're paying for some of these places some of these stocks are 20 to 25 times earnings. We think they can, just from an earnings CAGR alone, produce very, very dramatic results as a result.
So it's hard to talk about tech without touching on the tech space in China. We're seeing an appreciation in Chinese tech plays. Not as much as one would expect, given the comparison with the peers in the US. How are you assessing the rally that we've seen?
Yeah, so look, I think it's coming off of such a distress level from a valuation perspective that it's now kind of, but it's still very, very cheap within the context of history, right? And I think if investors were truly to be able to get confidence in Chinese markets, you could see even another leg of this rally because they still remain very, very undervalued. What we're focused on in China are the areas that the government is really focusing its investments in, and where it's focusing on is semiconductors, right? They're trying to become much more independent. And in order to be able to become independent, they also need to have local champions, but they also need to be able to create semi-cap equipment themselves. And so there are some emerging kind of areas within semiconductor market that, like for like, we're starting to see as much more interesting.
When it comes to the AI space, is it difficult to see China playing catch up in an accelerated way to the US?
Yeah, so look, I think there's a difference between building foundational models and building inference technology models, right? And I think from a foundational model perspective, it's increasingly difficult, right? Meta and all these companies have access to the latest GPUs, and they also have the capital to be able to continue to drive a lot of these frontier models in a very, very fast way. But what China has done is have had step function changes in how they're inferring from these foundational models and driving inference technology, and that's what DeepSeek is, right? And it's an entirely new way to be able to drive and leverage off of the foundational models that have been created.
So comparing NVIDIA with DeepSeek is like comparing apples to oranges. They're not on a level playing field because also when you take a look at the model of DeepSeek, it is open source. So talk to us about the value that Chinese tech companies can bring.
Yeah, like I think the Chinese tech companies obviously have tremendous innovation that they're bringing to market as well, not only in terms of the advancement of AI models, but also the applications that are being created around it. And so I think for the local audience as well as some of the emerging markets audience, and as they broaden out their reach, that's the opportunity set that exists for the Chinese tech players.
I'm curious to talk about the supply chains in the chip sector and the tech space, especially on the back of the trade war and the increasing pressure that the U.S. is putting on China.
Yeah.
How do you see that playing out?
Yeah, look, I think it's pretty clear that the U.S. is using chips increasingly as a bargaining chip. And I think one of the things that we do worry about with NVIDIA is that they become kind of a geopolitical tool versus, the fundamental growth, allowing it to fundamentally grow and persevere. So, it's an open question. I wish I knew all the answers around it, but I think there's going to be a lot of question marks going forward.
But in terms of supply chains, how do you see that more dispersed or, spread over?
Certainly, like one of the things that's going to happen is there's going to be a fundamental reshoring of a lot of this technology, right? I think the U.S. has a target to say, we can no longer have 90% of all of our, or 95% of all of our output be manufactured, leading edge output manufactured in Taiwan. We need to be able to bring that a lot onshore. So we're targeting 20% of semiconductor manufacturing over time in the U.S. EU also has a CHIPS Act that they're trying to bring more manufacturing and semiconductor capacity onshore. Japan has taken investments from TSMC and from Micron to be able to bring semiconductor manufacturing onshore. And all of that is happening and creating some level of duplicative capacity around the world. And in that build-out, one of the areas that benefits the most are semi-cap equipment companies.
We've talked about how tech has been caught in the crosshairs of the U.S.-China trade war. What are the other key themes or concerns that you are looking out for in the next 12 months?
Yeah, look, I think it's policy, right? And I think it's trade policy that we're thinking about. I think it's also probably this AI risk that I talked about, right? I think there's a lot of concerns about the AI CapEx and the trajectory of AI CapEx, especially as we go into 2026. I think 2025 is increasingly getting firmed up. We know what the capital budgets are going to look like. But in 2026, we still don't really have full clarity. But one thing that gives us a little bit more confidence around the trajectory of 2026 is the advent of reasoning AI models. And so this is the next leap forward that's coming in AI, where right now when you ask a question to GPT, it gives you a very linear conversation. You ask it a question, it gives you an answer. But what's going to happen with reasoning, it's going to remember all the questions that you asked prior. It's going to give you all of the things that you typically like to do on a day-to-day basis, and then actually act like an agent and an analyst for you. And because that reasoning capability, and Jensen will say that this is 100 times more compute intensive than linear reasoning models, that like as a result of that, the trajectory of CapEx probably just continues into 2026.
So it means that in 2026, 2027, your strategy for tech investing will have to be slightly different from what you're adopting right now.
Yeah, it's always evolving. We could have the same conversation, and I could be sitting here a week or two from now, and I could have gotten, the great thing about investing in the public markets is I always reserve the right to change my mind at any time.
Sun, good to have you with us.
Yeah, great to be here.
Co-head of Public Tech Investing and Portfolio Manager at Goldman Sachs Asset Management. Still to come. Indian Hotels joins us with their insights on the hospitality sector. After fourth quarter earnings, misestimates, our exclusive conversation with MD and CEO Puneet Chhatwal just ahead. Keep it here with us. This is Bloomberg. Welcome back to Insight. The volatility flaring in the currency markets right now could have far-reaching effects, and the travel and hospitality sectors could be particularly vulnerable. India's largest hospitality company has just released fourth quarter earnings, which missed estimates. Net income at Indian Hotels rose 25% thanks to continued domestic travel demand. While domestic tourism has been strong, India has struggled to lift inbound tourism. Now, the company is placing more emphasis on attracting international travelers. Joining us exclusively is Puneet Chhatwal, MD and CEO of Indian Hotels. Puneet, good to have you with us. How much clarity do you have in the coming financial year?
I think everything is moving in the right direction. The demand continues to outpace supply, and our growth on not like for like is helping us achieve better quality top line, as well as very strong fundamentals on capital light model versus our traditional capital heavy model for several decades.
In terms of your growth strategy and growth drivers, what are the key ones?
Well, we have used several levers. The first one being using fee-based model for the growth as a very strong percentage. In the last quarter, it was almost 95% based on capital light. Second is a strong emphasis on new business, which is also driving higher margins, because we don't take any new business which is giving us a margin less than 35%. Third is our asset management initiatives. As we have a lot of iconic assets that we own, we've been able to renovate them smartly and drive better operating leverage from those existing iconic assets. And fourth is, growing on the brandscape. We have added brands in all segments, either reimagined them or relaunched them, and also introduced new brands. So today we have almost 10 brands versus a few brands 5-6 years ago. So I think in all aspects, addressing the needs and wants of a heterogeneous market like the Indian subcontinent, which is our main market, I think we've made very good progress.
How closely are you watching the Indian economy on the back of expectations of slowing growth in the world, and also on the back of rising tensions between India and Pakistan? If that should escalate, might India's growth be impacted?
Well, these are things, how geopolitics plays out, that is very difficult for hospitality management to predict or address on. All I can say is the worst that I have seen in my 4 decades in this business is COVID, when our revenue crashed to zero. The whole sector was demolished, and we saw how resilient the sector was, and it came back very strongly. So I think once you have done with zero revenue, I think I don't know what else could get worse. And that gives us a lot of confidence. We know what needs to be done should there be any headwinds coming along. And I think that way, this 3 years ago, the learnings through the COVID-19 have been immense for the sector in general, but also for companies like us, which was very capital heavy at that time in particular.
So is it fair to say that you're not seeing any slowdown in terms of tourism, travel demand, or, people cutting back the spending?
We actually have given that guidance yesterday in our investor call, that in the month of April, we saw almost 17% growth in the top line. And the business on the books in the month of May and June looks very good. But traditionally, the best quarters for the sector have been, the strongest one being Q3, which is October to December for us, and the second strongest being Q4, which is Jan to March. So that is still far out, but we are seeing a very strong Q1, because the same time last year, there was an excessive heat wave coupled with the code of conduct because of the once in 5 years the elections in India.
Puneet, you talked about how India is your key market, but you have a global footprint. You're in 4 continents. Given the gyrations in Asian currencies in particular, how do you see that playing out in terms of your numbers?
We have taken a strategic decision to only grow with the Taj brand across key gateway markets in the world. Given that we are a net debt-free company with almost 3,000 crores of cash, if need be, both within India as well as outside, we could capitalize on any opportunistic deals that might come our way, whether it is related to a M&A activity or even a single asset strategic move on a capital light model. But that means we could still take on some form of sliver equity or put some skin in the game on the international front to keep growing the footprint of the Taj brand across the globe.
We know that you're trying to attract more international visitors. What is the strategy there? How much upside do you see?
This is a very interesting one. As India has gained in its economic importance across the globe and becoming the 5th largest economy, there is a lot of business travel coming in from outside of India. However, when we actually say the amount of foreign tourist arrivals, it still lags the pre-COVID number. And we are increasing our presence at international trade fairs. We are supporting the tourism sector, the travel agent fraternity, both online and offline, to increase the amount of foreign tourist arrivals in India. And we are seeing an upsurge in that number in the last 100 days or so. But now is not the highest time because of the summer months. Hopefully we'll be better positioned to continue and pursue this activity as of September, October of this year, when the weather is more conducive and more favorable for foreign tourist arrivals.
And you're also looking to add more than 30 hotels this year. Where are you with that, and how do you intend to fund that?
We have opened 4 hotels, but as I mentioned, that most of our openings that are also lined up this year, except for 3 of the 30, they are on capital light model. So it's not our capital. It's based on a management contract with owners who have put in their money. And the 3 that we are opening with our own capital, those have already been paid for or funded through our internal accruals, which is not a part of the gross cash that I just mentioned that we have on our books.
And in terms of the risks you see on the horizon, you're pretty optimistic so far. What might be a risk to your projections?
See, the risk could be my optimism. I'm usually and I think any kind of gloomy factors that come, they too shall pass. Important job for the management is to navigate through any kind of headwinds. And I think we have successfully demonstrated that consistently, not just in the last 12 quarters, but I would say in the last 5 to 7 years. And we have stability in our management team. The team has worked very well together, and I see no reason, should there be any risk coming, why we should not be able to mitigate those, especially when you are not looming under high debt or you don't have a diversified portfolio or diversified presence. With 130 destinations that we cover in India, I think we are very well hedged to counter any risks that might come our way.
Glass half full kind of guy, Puneet Chhatwal, MD and CEO of Indian Hotels. Well, Coca-Cola and Pepsi's decades-long dominance in India is under threat from a 12-cent cola backed by India's richest man. Reliance Industries' Campa Cola has achieved double-digit market share in key regions barely 2 years after its relaunch. Bloomberg's Sadviki Sanjay joins us from Mumbai. Sadviki, how is Ambani challenging the dominance of Coca-Cola and Pepsi in India?
Mukesh Ambani, in Asia's richest man, has challenged the dominance of Coca-Cola and Pepsi in India by a strategy he's used across sectors that he's present in, which is through a disruptive pricing. He offers a 200 milliliter bottle for 10 rupees, which is about 12 cents. That's roughly half of what Coca-Cola and Pepsi charge for similar sized bottles. And that's essentially brought in double-digit market share for the giant in the 2 years that he's been present in the India market. Industry experts say that Coca-Cola and Pepsi's Reliance's growth has come from Coca-Cola and Pepsi, and that some market expansion might have also happened because of the low pricing that Reliance brings in.
We know that India has more than 1 billion people. It is going to be a very important market for the two cola giants.
Definitely. India is becoming a strategic market for both cola giants, Coca-Cola and Pepsi, partly because of the slowdown that it's seeing in its primary markets in the US, be it due to the presence of GLP-1 drugs, be it due to consumer pullback, or due to tariff-related headwinds that have led to Pepsi cutting down its guidance for the year. So for both these consumer companies, which continue to see growth, even as Ambani's presence comes in, they're going to be focusing heavily on the India market. For Coca-Cola, India is their fifth largest market so far.
Vicky, talk to us about Reliance's strategy. Is it the same strategy it brought to telecoms and media to the cola business?
Definitely. It's the exact same strategy that Ambani has been using across his industries. In 2016, it disrupted the telecom sector with the entry of Chiu, which essentially offered free data to billions of Indians, right? And it's now disrupted the media industry with the entry of Jio Hotstar, which is essentially a rival to Netflix and Amazon. So here they're disrupting the market with a very cheaply priced cola. And India, which is a very low disposable income economy, 12 cents can mean a make or break difference for most of its consumers. That's also caused, Reliance's entry has also caused some of its rivals, including Coca-Cola and Pepsi, to either cut prices or to bring in similarly priced newer variants so that they can also get in on the game at 10 rupees or 12 cents. Some of its rival companies in India have had to readjust their retail network and as well as build more chilling equipment. So industry insiders also see Reliance's entry, Ambani's entry as pushing the market to grow further.
Vicky, thank you so much for that. Bloomberg's Vicky Sanjay in Mumbai. Let's do a check on Asian currencies. We're seeing a rebound in the dollar index. We're seeing pressure on Asian currencies as a result of that. Of course, we're tracking Asian currencies on the back of the stunning spike we've seen recently, especially for the Taiwan dollar, reverberating across global FX. We have the yen currently trading at 143.78 versus the USD. It is down by about 0.1%. We're seeing losses too for the likes of the Chinese yuan, the PBOC keeping that currency stable. Now, before we go, here's a look at tomorrow's show. Monitor's chief global market strategist will be joining us with an analysis of the latest market swings triggered by Trump's tariff policies. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is